All right, welcome everyone. Step right on into our digital classroom. Now, today we are going to decode one of the absolute most mysterious and honestly downright frustrating experiences in the entire trading world. Seriously, it drives people crazy. So let's just jump right into a scenario, okay? Picture this for a second. You're analyzing the charts and boom, you spot it. A perfect setup. You enter the trade. You do literally everything right by the book, including placing your stop loss to protect your account. And then the price dips. It touches the exact precise penny where your stop loss is sitting, kicks you completely out of the trade, and then it instantly reverses. It shoots up like a rocket in the exact direction you predicted. I mean, has this ever happened to you? You were totally right about the direction, but your stop loss just got hit first?
Yeah, I can see a lot of you nodding right now. It is the ultimate frustrating cycle, isn't it? You get the direction perfectly right, your stop loss gets tagged out of nowhere, and then a massive reversal happens, just leaving you in the dust. It feels super personal, doesn't it? Well, I promise you, you are absolutely not alone in this cycle. Today, you are going to learn exactly why this happens, and more importantly, how experienced traders reduce the chances of this happening to them so, they can actually protect their hard-earned capital. Now, before we get into the whole hunting thing, we really need to clear something up. Let's reframe what a stop loss actually is. Think of it kind of like driving a car. A seatbelt protects you during an accident, right? You would literally never drive on the highway without one. Well, in trading, your stop loss is your financial seatbelt. It protects your trading capital when the market unexpectedly moves against you. You should never, ever treat it as optional. It's an absolute necessity for your protection, not some kind of sign of failure.
So, why does the market seem to always find your seatbelt and just unbuckle it? Well, our source material reveals a huge paradigm shift here. It states plainly that big players know exactly where the target and stop loss of retail traders actually are. But here is the big secret. The market isn't targeting you personally. It really isn't. Large financial institutions, they just need massive amounts of buying and selling interest to execute their huge orders. So they're simply hunting for liquidity. And, well, your stop loss is just a tiny little drop in that massive pool. Okay, so to understand where all this liquidity actually lives, we've got to understand market structure. By definition, market structure is the absolute simplest form of price movement. We're talking about your basic support and resistance levels on the charts, the swing highs and the swing lows. I want you to think of these structural points as giant glowing magnets. Because they're so incredibly visible, they attract massive clusters of pending orders from traders all over the world. And, well, here is exactly where we become a bit too predictable. When thousands of retail traders learn these exact same textbook chart patterns, your double tops, head and shoulders, wedges, flags, they all end up placing their trades at the exact same time. And worse, they hide their stop losses in the exact same, completely predictable places. Just notice where these predictable areas naturally form. Look, in a bull trend with higher highs and higher lows, retail traders almost always place their stops right below the obvious swing lows. In a bear trend, they place them right above the swing highs. It makes sense, right? But when everyone puts their financial seatbelt in the exact same spot, it creates a massive pool of liquidity, a pool that large operators naturally sweep right through before they actually move the market. So let's see how this builds into an actual trap. Take a look here at this classic double bottom pattern. Now, this looks like a fantastic time to buy, right? But the big players, they create what's called a fake breakout. They let the price drop just low enough to sweep all those predictable stop losses sitting right below that support line. They quickly grab all that juicy liquidity, and only then does the market reverse into an uptrend. That textbook pattern literally just tricked retail traders into entering early just to sweep their stops. Which brings us to a major danger zone, entering without confirmation. Impatient new traders, they'll often jump into a trade the absolute second a breakdown appears to happen. They just don't wait for a confirmation candle to close. And listen, the big players know you're eager. They know you're impatient. So they trigger your aggressive entry with a quick drop, hit that tight stop loss of yours, and instantly reverse the price. If you want to survive this, you have to do what our source calls hacking the seller's mindset. Smart traders, they don't just stare at those obvious textbook patterns. They actually look at the market and ask themselves, hey, where are the impatient new traders putting their stops right now? Think about it. If you can predict where the crowd is hiding their stop losses, you know exactly where the big operators are going to sweep before the actual profitable move happens. So what's the game plan? How do we reduce our chances of being hunted? Well, here's your smart trader's playbook. Number 1,
Wait for confirmation instead of just chasing sudden breakouts. Seriously, be patient. Number 2, never place your stop exactly on those obvious swing highs or lows. You've got to give it room to breathe based on recent market volatility. Number 3, always check the higher timeframes before entering to make sure you aren't trading right into a massive structural level. And finally, keep your position size small enough that a properly placed stop loss is actually acceptable to your account. And never widen your stop loss just to avoid taking a hit. You have to use structure, not emotion.
And that brings us to the end of our explainer today, but I want to leave you with a final question to really ponder. Moving forward, will you continue to trade those obvious textbook patterns where everyone else gets hunted? Or will you elevate your mindset, start trading the actual market structure, and begin thinking in terms of liquidity and probabilities? You have the tools now to buckle your financial seatbelt the right way. Thank you so much for stepping into the digital classroom today. Remember to trade smart, and I'll catch you in the next explainer.